Funding options. Securing appropriate funding is crucial for starting or expanding a business, launching a project, or financing large-scale investments. Various funding options are available, each with distinct advantages, disadvantages, and suitability based on the type of business, project, or goals. Understanding these options helps businesses and individuals make informed decisions about financing strategies. 1. Equity financing. Equity financing involves raising capital by selling shares of ownership in the company to investors. This can be done through venture capital, angel investors, or crowdfunding platforms. Advantages: no debt obligation. The business does not have to repay the funds. Expertise. Investors often provide valuable advice, industry connections, and mentorship. Shared risk. Investors share the risk of the business, as repayment is only required if the business succeeds. Disadvantages: loss of control. Business owners may have to give up a portion of ownership and decision-making power. Profit sharing. A portion of the future profits must be shared with investors. 2. Debt financing. Debt financing involves borrowing money from lenders, which must be repaid over time with interest. Common forms of debt financing include bank loans, bonds, and lines of credit. Advantages: full ownership. Business owners retain full control and ownership. Predictable payments. Fixed repayment schedules help businesses plan their cash flow. Interest tax deductions. In many jurisdictions, the interest on loans is tax deductible. Disadvantages: debt burden. The business must make regular payments, regardless of its profitability. Risk of default. Failure to meet loan obligations can lead to legal action or loss of assets. Credit requirements. Access to loans often depends on the borrower's creditworthiness, which may limit financing options. 3. Grants and subsidies. Grants and subsidies are non-repayable funds provided by governments, non-profit organizations, or other institutions to support specific types of businesses or projects, particularly those focused on research, innovation, or social impact. Advantages: no repayment. Grants are essentially free money with no obligation to repay. Encouragement for innovation, often provided for high-risk projects that struggle to secure traditional financing. Disadvantages: competitive. Grants are highly competitive and often difficult to secure. Restrictions: grants typically come with conditions on how the funds can be used, limiting flexibility. 4. Crowdfunding. Crowdfunding involves raising small amounts of money from a large group of people, usually through online platforms. There are different types, such as reward-based crowdfunding, e.g., Kickstarter, and equity crowdfunding. Advantages: market validation. Crowdfunding provides early market validation by directly engaging potential customers. Minimal financial risk. No repayment is required in reward-based crowdfunding. Disadvantages: uncertain outcome. Success in crowdfunding is not guaranteed, and campaigns may fail to meet their targets. Time-consuming. Running a successful crowdfunding campaign requires significant time and effort in marketing and promotion. 5. Venture capital and angel investors. Venture capital firms and angel investors provide substantial capital in exchange for equity, typically in high-growth or early-stage businesses with significant potential. Advantages: large funding. Venture capital offers substantial sums of money, often necessary for scaling operations. Expertise. Investors bring valuable experience and strategic guidance. Disadvantages: dilution of ownership. Founders may lose significant ownership stakes and control over decision-making. High expectations. Investors expect rapid growth and high returns, which can create pressure on management. Conclusion: the best funding option depends on the nature of the business, project goals, and the level of risk and control the owners are willing to accept. A combination of different funding methods is often the most effective approach to balancing financial needs and long-term growth strategies.